Intel surged 23.6% on Friday. That is its largest single-day gain since 1987. The stock did not just rally, it broke above a price level it had not touched since the dot-com bubble, clearing an all-time high that had stood for 26 years. The Nasdaq 100 marked a fresh record. The S&P 500 topped its prior high from just 2 days earlier. And yet the headline that set all of this in motion was not about NVIDIA. It was not about a new AI model. It was an earnings report from a company that most of Wall Street had quietly written off. The session did not start that way. Oil was pulling back roughly 1% after Pakistan signaled Iran's foreign minister was heading to Islamabad for ceasefire talks, easing the energy-driven pressure that had dominated the tape all week. Consumer sentiment had just printed at 49.8, an all-time low in data going back to 1978, with the University of Michigan survey showing deterioration across every demographic. The same report showed inflation expectations climbing again, the direct consequence of the Iran war's disruption to Strait of Hormuz shipping. Procter & Gamble was absorbing a $150 million hit from Middle East disruptions. Lockheed Martin fell 3% on earnings. Exxon and Chevron, up 20% year-to-date on the oil shock, showed the first signs of stalling. Two markets were running in parallel on Friday. Oil and the old economy were reacting to geopolitical arithmetic. Meanwhile, the chip sector was computing something else entirely. Intel's Q1 revenue came in at $13.58 billion, up 7.2% year-over-year. Data center and AI revenue jumped 22% to $5.05 billion. That beat was meaningful on its own. But the number that moved markets was not in the income statement. It was in a comment from Intel CFO during the earnings call. In agentic AI workloads, the GPU to CPU ratio can actually flip. That one sentence reframed a thesis that has dominated semiconductor investing for 3 years. The assumption baked into NVIDIA's $5 trillion market cap and into the underperformance of every CPU maker is that AI runs on GPUs. Training large models does, but inference, particularly the kind that agentic systems perform when they plan and execute multi-step tasks autonomously, does not necessarily follow the same architecture. At scale, agentic inference may demand more general-purpose compute, more CPU cycles. Intel CEO Lip Bu Tan called this the next wave of AI, one that increases demand for Intel's chips specifically. The market responded immediately. ARM Holdings surged 14.6%. AMD jumped 13.3%. The SOXX semiconductor ETF extended what is now a 17-day winning streak, a record run. Cathie Wood's ARK bought Amazon and sold AMD the same day, signaling portfolio repositioning around the new compute narrative. Data Davidson upgraded AMD to buy with a $375 target, citing Intel's supply constraints as a direct opening for EPY server share gains. There is a condition embedded in all of this. The agentic AI thesis is not yet validated at production scale. Intel CFO was describing a directional trend, not a measured ratio from deployed systems. If the major hyperscalers, Amazon, Microsoft, Google, run their agentic workloads predominantly on GPU clusters, the flip narrative collapses before it begins. Google's announcement of a $40 billion investment in Anthropic, structured around compute access and Claude model deployment on Google Cloud, suggests the hyperscalers are not abandoning the GPU stack. They are layering on top of it. That is a different thing from replacing it. Intel's last comparable single-day move was 1987. That context matters more than it might seem. The 1987 surge came during a different kind of repricing, one driven by macro relief, not product thesis. Friday's move is fundamentally a bet on a structural shift in how AI inference gets built. Those bets have a longer resolution window. The near-term verification comes in 2 waves. First, the Mag 7 earnings cycle that runs through next week. Amazon reports Wednesday. Microsoft and Alphabet report Tuesday. If their data center commentary confirms that CPU demand is growing alongside GPU demand, that agentic workloads are additive, not substitutive, Intel's new high holds a foundation. If their results show GPU capex absorbing everything and CPU demand remaining flat, the repricing reverses quickly. Intel stock has moved on a single earnings call and a single CFO comment. That is a thin base. Second, Meta and Microsoft announced up to mind 20,000 to 23,000 potential job cuts this week, pivoting explicitly toward AI-driven efficiencies. That simultaneous compression of human headcount and expansion of compute spend is what the agentic AI thesis predicts should happen, companies replacing labor with autonomous agents that run inference continuously. Over 92,000 tech workers have been laid off so far in 2026, according to layoffs.fyi. If agentic deployment is accelerating fast enough to drive that kind of labor displacement, CPU demand at scale becomes more plausible, not less. The current evidence leans toward the CPU resurgence thesis holding through earnings season. Intel's data center revenue growth was real, not projected, and the agentic AI transition is structurally distinct from the training-era GPU buildout. But that lean holds only if the hyperscaler earnings next week confirm the demand signal rather than contradict it. Consumer sentiment at record lows and oil-driven inflation still running in the background mean the macro floor is thin. A single disappointing guidance cut from Amazon or Microsoft on data center spend would test whether Friday's move was a genuine thesis shift or a short covering event in a stock that had been chronically underowned. The question Friday's market left open: when Intel CEO says agentic AI is the next wave, is he describing where the industry is going, or where Intel's customers have already arrived?